G'day expats and welcome to episode 4 of Expat Chat. James, it's another edition and always lots to talk about. What are we running through today?
Always. So on today's agenda, we'll briefly touch base on the recent webinar that we talked with our expert on the risk side.
Oh yeah, on risk insurance, with Darko.
Talk about the upcoming budget and the webinar that we're going to be hosting.
Yep.
And then also just one of the biggest financial risks to expats.
Yep.
And then just a minor update on what's going on with the Main Residence Exemption. There was a recent article by the Financial Review. And then I've got about 3 to 4 questions I'm just going to throw out to us just to address something quite straightforward. So a bit of Q&A.
Yep. Right, let's get the show on the road. Those who are watching on YouTube would have seen the little disclaimer appear down the bottom. But for those who are listening on podcasts, obviously any information we talk about today is general nature and you should not consider this as personal advice. So let's get the show on the road.
No dramas. So, Brett, obviously, last week we conducted that top 10 problems Australian expats face in regards to their insurance.
Yes.
So, that was obviously with Darko. I'm going to probably fail pronouncing his surname.
Ziggy. Yep.
Ziggy. Yep. Okay.
Yep.
So, he works with Bena Financial Solutions. He's our go-to guy for expat insurance.
Exactly.
The webinar, it ran for about, what was it 30 to 50 minutes? Or
I think it's about 45, 50, yeah.
Yep. And then, it's obviously put on YouTube now, put it on as one of the podcasts.
Yep. I will put the link in the show notes below for both the description on YouTube and also show notes on the podcast as well, so people can watch that as well.
Yeah, that's right. And I think it was a great webinar to do because it cuts through a lot of the crap that's out there on the internet when it comes to insurance policies. It's likely to probably raise more questions once you actually watch it because you're like, okay, I actually haven't looked into that regarding my super fund insurance or these policies that I've got, which I thought was safe. Most
people don't know they've got any insurance at all in super. They just get on a plane, they go away, they're away for 3, 5, 10 years, expecting, and they always have the complaint that balances go down. But they're unaware that
what's coming out.
There's actually premiums coming out paying for insurance that what we've found is most of the time they can't claim on it anyway because they're non-resident.
Yeah, that's right. I mean, Darko even mentioned a lot of the carve-outs that you see on these product disclosure statements associated with those default insurances on the super funds. It'll say worldwide cover, overseas cover. It says, yep, you cover 24/7 no matter where you are in the world. But that's actually mainly referring to like a holiday or a few months that you seconded overseas for work. Not something in the case where you've left Australia permanently because you're a non-resident now.
Yep.
On paper, you're not coming back, and that's the treatment of a non-resident for tax purposes, and that changes things, and people don't realise that.
No, that's right, and amount of times I've spoken to people, and they've actually been on the front foot.
Yeah,
they've called the super fund, and they said, "Oh, we're going overseas. Are we covered?" What they don't do is tell them the basis of them going overseas.
Yeah.
So the call centre just assumes they're going on a work trip or a holiday.
Yes, that's right.
And they say, "Yeah, no problems at all. You're covered. You're covered."
Yeah.
But then they, get over there thinking that, okay, it's great, I can claim on my life or TPD insurance. When in actual fact, if you're living overseas permanently, then no go.
Yeah, it's the typical one when it comes to assumptions, the mother of all.
Yep.
Anyways, further on the insurance, I think Darko didn't name drop the providers, but he said there's 3 main ones which are usually quite comfortable with providing expat insurance.
That's right.
And other things that do impact is where you're residing. So,
yes.
The type of country.
DFAT 5 countries, Iraq, Syria.
War-torn. War-torn, sorry. And then the other factors are, years that you've been overseas.
Yes.
And I think the last one was the intention to return.
Yeah, it ties back to Australia. Yeah, that's right. You've always got a better chance of getting something when you have something tying you back to Australia, whether it's property or your kids going to go to school or all those sort of things. And I think it's getting insurance as an expat is very different than, say, a resident.
Yeah.
Because just to sort of, without getting too technical with everyone out there, when you get insurance as an expat, you get what's called pre-assessed before cover is provided.
Yes.
Which means that you have to go out to all these different insurers and say, hi there, we've got Fred Smith, he's 45 years old, he lives in Hong Kong, wife, kids, or, give them the whole colour.
Yeah.
And it's like a speed dating service because you go out to all these different insurers and say, who wants it?
Yeah.
Whereas in Australia, when you're a resident, normally what happens is you'll sit with an advisor and he'll go and find you the best cover, suits your circumstances, you go through everything, then you get assessed after the process. Whereas with expats, it's right at the beginning.
Yeah.
So, and it's funny how different insurers, they'll tell one advisor one thing, but they'll tell another advisor something completely different. And, we obviously have that case quite often where we talk to other advisors who try to get cover and they can't. But then when we go through our channels, we can get it because we've got a relationship with that underwriter.
Yeah, that's right.
And they know our clients. They know what sort of business we're working with.
Yeah.
And they have a lot more comfort. So, just everyone out there who do talk to advisors, if you are looking at getting insurance, just because one advisor can't get it doesn't mean another can. So, just always have a good look around, and it comes back to that topic we'll do down the track about picking an advisor.
Yeah, and I mean, further on that, obviously, some advisors, it always comes down to the products they're aligned with.
Yes.
So if they're only aligned with 5 insurers, it could be the case where those 5 insurers don't actually touch expats at all. So they might go back and go, listen, no one's going to give you expat insurance. We've just asked our insurers. And again, you'll make an assumption, I can't get expat insurance.
Yep.
Can't apply for it. I'll wait till I get over in that new country.
Yes.
And then I'll go through the routes, trying to
Offshore.
apply for it there. One other thing Darko mentioned was if you do get expat insurance set up, when you return to Australia, it's always good practice to let the insurer know you're back, because it can sometimes be the case that that insurer is taking on extra risk because you're going overseas. So now when you come back, your premiums might be actually a little bit less because they might have loaded on a slight loading to accept that extra risk. So always updating your insurance provider and your financial planner to set up the obviously relative insurance policies. So
definitely,
I suppose we go into it in the webinar. That's a bit of a sneak peek, essentially.
Yeah. So look, have a look in the description below, and I'll link both the YouTube and the podcast URL so you can listen to that or watch it later.
Yeah, sounds good. So moving on, obviously big news: April budget.
Yep.
Brought it forward a month.
Yes. May election.
Yeah, that's right. Can't wait.
Yes, that's right. It's always a highlight on my calendar.
I mean, from my own point of view, I'm quite nervous about Labor and their proposals.
Look, it's it's something that I don't know whether it's arrogance or what, because in past years we've seen political parties sort of converge a bit in terms of their policies.
Yeah.
So it wasn't too extreme, but it appears Mr. Shorten's taken a very extreme approach to this one.
Yeah, that's right.
And unless you're what I call a party faithful, you're in their target.
Yeah, that's right. And I think looking at Labor's proposals, which I've downloaded here, and we briefly touched base on them last week as well, previous episode. I honestly, there's probably 5 out of 10 proposals which directly impact expats.
Yeah.
And
but you'd never find the word expat in them at all, and that's the funny thing, how expats won't know about it until it's too late.
Yeah, exactly right. It's not something which is specifically targeting them, but it's something that directly is going to impact them. And I mean, the rule regarding personal concessional contributions, the 10% rule, that one really scares me, because a lot of my own clients I know that that have income coming off properties where they can funnel into their own super funds.
Yep.
And now they're looking to reintroduce the 10% rule, which a brief summary is you essentially need to be self-employed to be able to make contributions and claim it as a tax deduction.
As a concessional contribution, yeah.
Yeah, that's right. So by removing or reintroducing this old rule, even I can't go and make personal tax deductible concessional contributions because I'm an employee.
Yep.
So that one is really scary because it's going to have a drastic impact on the type of tax that expats will pay each year on that sort of income.
Yep.
Obviously, the trust rule, not a big fan of that one.
No, that's a scary rule as well too, and I think they actually interplay in a lot of ways.
They do. Yeah, you're right. I mean, you'll still get taxed at minimum 30% technically, but changing that is huge because I know a lot of people still operate trusts when they're away, which they need to be obviously careful of central management control and those sort of things. But another big scary one, the catch-up rule, catch-up concessional contributions. Yeah,
because finally we actually saw something that expats could really take advantage of.
Oh, absolutely, especially when it comes to overseas provident funds and super funds. Even overseas investment property, that's accumulating in the background, just an overseas investment essentially, and trying to offset.
Well, just the ability to manage your cash flows and funnel it in different ways.
Yeah.
That could sort of negate or remove, tax liabilities.
Yeah, well, that's right, and I think when I saw the catch-up concessional contribution rule come into play, I was excited.
Yeah.
Because I knew it's going to have a great impact on a lot of expats.
Yep.
In a positive way. They can essentially maximise this contribution and effectively have a flat line tax rate of 15%.
Yeah.
Assuming that they leave assets behind and whatnot overseas. So the fact that they're going to yank that away straight away means that if people are using that rule, building up this $25,000 concessional contribution that they haven't used this year, they're going to take it away next financial year. So essentially, you've missed out on making a $25,000 contribution into your
that's right,
and claiming it as a tax deduction. So that's retrospective in itself.
It is because I think it's you need to accumulate it first before you can use it.
Exactly.
But if they take away the functionality of accumulation, then you can't use it anyway.
Yeah, exactly right. So those are some of the main key ones. Obviously, the reduction of the non-concessional contribution.
Yeah, look, it's it's becoming harder and harder now to put money into super.
Yeah.
Not harder, but it's in terms of getting reasonable amounts of money in there.
Yeah.
The good old days of Johnny Howe with no limits. That was a bit of a free for all. But
you shocked me the other day when you told me about some of the balances in SMSFs these days.
Yeah, well, there's
from the old rules.
Yeah, that's right. I mean, there's actually SMSFs out there with over $100 million in them.
Yeah.
And just to sort of take a step back and not to divert too much.
Yep.
When the government wanted and made a big push, concerted effort into getting Australians to fund their own retirement, they said you can put as much as you want into your super.
Yep.
And I actually had clients who were mortgaging their unencumbered properties.
Yeah.
Sometimes into the millions.
Yeah, yeah.
And then dumping that whole load into super.
Yep.
And then what they were then doing is then paying down the mortgage, and then suddenly got a big lump sum in super and happy days.
And they've funded their retirement essentially.
Exactly. And even when it was, at the $180,000 per year limit, that was still a reasonable limit. You could put in $540,000.
Yeah.
Quite easily.
Yeah.
And that was not even including doing the whole straddle between the financial year and the calendar year. So I never really had many clients who maximised that one.
Yeah.
But now, if we are going to drop below 100, it's going to mean that expats are going to have to plan further in advance.
Yeah, that's right.
In terms of getting this through, because they can't sort of rely on 6 years to get all their money into super.
Not at all.
It's going to have to be almost out to 12 years.
Yep.
If these balances do go down, if a Labor government does get in, if that does come down to 75. It could go down to 50.
Yeah.
It could get worse.
Yeah.
So, like any of this sort of stuff, it always scares the bejesus out of you when you see these things. Whether we see everything implemented in full, if they do get elected, whether there's a trade-off along the way. A lot of the time, politicians like to announce things, but then they realise what they announced wasn't exactly practical, so they sort of water it down. Or
we'll touch base on that with the MRE.
MRE, exactly. That's a classic case in point. Yeah. So, it's going to be a difficult one, but there's nothing positive coming out of Labor right now anyway.
No, and I mean, further on the non-concessional contributions, bring it back to 75,000, just the kind of impact that's going to have on expats with bringing back their foreign super funds.
Yep.
I mean, remember, when they come back, they've got that 6 month grace period in which they can bring it back. Obviously, no applicable tax after that, applicable fund earnings.
Yep.
But, 225,000 they can get in technically.
Yep.
Because obviously that's the bring forward non-concessional contribution cap rule now. And previously 300,000. So there's a huge difference there.
Yeah.
And if you can't get it in within those rules, then you can't necessarily just do it in tranches, because it has to be all or nothing.
That's right.
The only case you can do that is when you've got multiple SIPs with the UK side.
Yep, you can split it up but
then you've got to go down the QROPS path, which
bingo.
I mean, it's a nightmare in itself.
Yeah.
So it's case by case, and essentially it is a scary rule, because now we can only do, instead of getting 400,000 in 2 months, which is a complex strategy in itself, we can only do 300,000.
That's right.
So it's ridiculous.
And that 6 month rule does make it difficult, because if you do not bring it in within that 6 months, essentially you'll be taxed on any growth.
Yeah.
In that time. So if it takes you 6 years to bring a UK pension back, or some sort of foreign pension back in that time frame, you could be looking at paying tax at a CGT level.
Yeah. For
that 6 year period.
Oh, absolutely.
Not to mention what you're being taxed in the UK or wherever it may be.
Yeah, and I mean, it's not like you get the 50% CGT discount concession doesn't operate with those type of assets either.
That's right, yeah.
So it's not just because you've held it for a period of greater than 12 months and you've been a tax resident, you don't get to discount that.
No, not at all.
So, Yeah, like I said, it's an annoying rule that's they've announced. It's going to be interesting to see what they say. And I think they're also looking at maybe changing the 1.4 million or the 1.6 million dollar rule by the looks of it as well, this total superannuation balance cap.
Okay, yeah.
But that's something which I don't think will happen.
Look, it's, what do they expect? I mean, I know they're trying to drive up tax revenues.
Yep.
I mean, that's in concert with what they're trying to do with franking credits as well.
Yep. Yeah.
So they would rather people accumulate wealth outside of super, which is how I read it.
Yeah.
Don't put money into super, put it outside of super.
Get the tax at a higher rate. So why wouldn't
Exactly, that's right.
Yeah.
So, and then, we've done these strategies before with older clients who didn't have the benefit of growing up with super through their working career, and we've held assets outside of super. And there's still benefits we can do there with franking credits and all those sort of things to offset some tax, but there's still a lot of tax to pay.
Oh, absolutely. And I suppose one of the other rules I just read there, I didn't realise they were going to cap our tax, so our accounting fees as well at the moment.
Oh, really?
Regarding personal tax deductions.
Yeah,
so
yeah.
If you've got quite complex tax matters,
Yeah.
And you're paying high tax agent fees, you can only max out at 3,000.
Wow, that's not a lot for some people out there who have got some really complex ones.
Multiple trusts, family trusts, SMSS, all these other things.
Yep.
So, it's not an exciting budget, to be honest.
No, I'm not exactly enamoured with what's coming out of them at the moment.
That's right. I mean, let's briefly touch base on the seminar that we're going to be holding.
Yes, so
Seminars,
yeah, that's right. So 2nd of April, it's probably the earliest budget I've ever seen.
Yeah.
They're bringing it forward because obviously they got to call an election in May.
Yep.
So 7:30 p.m. Everyone's excited. On Tuesday night, is it? I think it's Tuesday night. 2nd of April. Watching the screens. What we're going to do is we'll analyse what's announced.
Yep.
And then the next morning at 10:30 a.m. Australian time.
Yep.
And then the same at 9:30 p.m. Australian time.
Yep.
We'll run live webinars. So that those two time frames pretty much should cover the world.
Yep.
If you're in the US, obviously the 10:31, it's 8:30 New York time.
Yep.
5:30 LA time.
Yep.
But also if you're in Asia and you want to have an early start, I can't exactly imagine waking up to the budget talk, but anyway, if that's the way you're inclined, fantastic, we'll be there. But then if you want to watch the nighttime one at 9:30 p.m. Australian time, obviously that's 7:30 in Singapore, 3:30 in Dubai, and then 11:30 in the morning in London. So I think we've got everyone covered there.
Yeah, I think so. And I mean, we'll be recording it as well, won't we?
Yep. So virtually, the best way to do it is if you cannot attend to any of these ones, still register. There will be a link below to register for the webinar, either of them.
Yep.
And even if you can't register, even if you can't watch it live, register because we'll send out a recording after. We will be having Q&A at the end.
Yep.
And even if you can't attend live, email us your questions at info@atlaswealth.com.au. You'll get our email address when you register. You'll get a confirmation email from us. So you can reply to that and say, hey, I can't attend, but could you answer these questions for us?
Yep.
So, I mean, it's going to be a bit hard for them to ask questions when they don't know what the changes are announced.
Yeah, exactly.
But, we'll see how it goes anyway. So if you do want to see that, I implore everyone. That's probably our biggest webinar of the year because it affects everyone. Yep. And it's funny how people say, it doesn't affect me, but I've never had a budget before that hasn't affected an expat from the age of 20 to 100.
Yeah, in some sort of...
There's always something.
And I mean, that's the benefit of doing this webinar because we're focusing on just expat issues.
Exactly.
We're not customising it to your standard, normal individual Australians. It's purely customised.
We're not talking about Centrelink. We're not talking age pension, those sort of things. No. It's issues that affect expats this very minute. I will put a caveat on there that, and I think we'll talk about in a sec about MRE.
Yeah.
So and I'll dovetail this into the webinar as well too. There was a Tax Institute National Conference last Friday it was, and the Assistant Treasurer, Stuart Robert, was asked a question about a piece of legislation regarding distributions to minors from trusts. And his response was, sometimes when we propose legislation, we're better off just leaving it there and forgetting about it. And then a little bit later, someone asked the question about the proposed main residence exemptions for expats. And he said, please see my previous response.
I know.
So, look, it's a first good start. my concern is the government hasn't come out and made a formal announcement that it's dead.
Yeah. Well, I mean, I read that article in Financial Review. I actually took nothing away from it because I was like, typical politician.
It's a reiteration of what we know,
Yeah.
and then a politician saying maybe not.
Yeah. I don't know how to answer this question.
Yeah.
You know, see above.
Exactly. And not that I'm a suspicious person, but the government has been so hell-bent on getting this through.
Yeah.
My biggest concern, and we wrote a post about it the other day, but it certainly could be the case, is that we see MRE Mark II legislation 2.0 being announced.
And what do you think that could be?
It'll be an abridged version of what it is now.
Yep.
The points that really hit home with Canberra, they didn't really care about preserving MRE for Australian expats while they were resident.
Yeah.
The issues were more on the estate planning side and the family law side.
Yep.
So maybe some amendments regarding that. If they are going to push this through, I would love to see that high watermark level, reset the cost basis when they become a non-resident.
Yeah, okay.
Then if they're going to put it through, that's what I want.
So essentially, individuals that are heading over will still get the benefit of a partial MRE.
Yes, that's right. So while they've owned the property as a tax resident in Australia, they'll get the MRE. They move overseas, they'll accrue CGT, the non-resident marginal tax rate.
Yep.
But there's a demarcation there between the two tax statuses.
Yeah.
Whereas under the proposed legislation at the moment, there is no demarcation.
Yeah.
You can be an expat for 2 years and an Australian resident for 20, and you'll still be taxed like an expat for the whole period. So
it makes sense that they would go down that. I suppose the Brett Evans proposed amendment.
Yep.
I'll start calling it that actually.
Yeah, we can hashtag that one.
Trademark it as well.
Yeah, that's right. Yeah.
Let the government use it. But essentially, that would operate similar to the way investment properties work.
Exactly.
In regards to the capital gains tax discount. So
that's right.
Absolutely makes sense. Obviously, when you leave Australia, treat it as a foreign resident. And essentially no longer accruing the main residence exemption. It's applied, it's crystallised there. When you come back, obviously the old rules still apply.
Bingo.
But it might be the case where they might still treat it as that investment property where for that period you can never discount it, you can never apply capital gain, all these other issues that come into play. But you're right, I mean, there needs to be clarity and probably an amendment of the transition period.
Yep.
So obviously that's 4 months away.
There's no way they can put this thing through till 30 June.
Yep.
Their focus is going to be on the election.
Yeah, of course.
So they're going to be calling in chips with all the different senators and all those different people, to sort of get through what they can get through.
Yep.
My gut tells me if they do a Brett Evans MRE Mark II, then it'll be probably as of budget night this year, with 30 June next year as the deadline.
Yeah, okay.
I think it'll be quite quick.
So taking it out another 12 months.
Yep.
Okay.
Yeah, because I think that's the biggest problem that we're meeting expats every day who don't even know this is proposed.
No, they don't.
So I don't know whether the government expects people to learn by osmosis or ESP or what.
Yeah.
We've certainly done our best in trying to get the word out there.
Well,
but
in these situations, you can educate. Educate. Because it's still draft stage, we can't tell people what to do.
No, that's right.
It's a case where the piece of legislation. If it goes through, this is what's going to happen. Yep. If you sell your property while you're a non-resident, this is the potential tax you'll have to pay.
Yes.
But at the moment, it's just flipping a coin, isn't it?
It is, and it's sort of like it's trying to hit a moving target.
Yeah.
It's like, well, we're aiming over here, no, we're aiming over here. You just don't know. Anytime we provide financial advice to an expat, there's always a chronology in that advice. Yeah. But right now, we're like, well, this may or may not go through. 30 June this year may not be a big date for you.
Yeah.
And I think, I've heard out there talk in the sort of expat media that there was a lot of unnecessary hype regarding this. And to me, it's yes or no.
Yeah.
And I was thinking about this, driving yesterday. If you look at the average age of an expat that goes overseas, more than likely it's a young couple.
Yep.
Now, they've probably bought their first home together, they probably got engaged, married, and they said, rightio, let's go overseas. Well, may not be married yet. Mm-hmm. So it might be a 2 or 3 bedroom place. Yep. They go overseas for, say, 7 to 10 years. Mm-hmm. Surprise, surprise, they've got a family, those sort of things now. And that house that they've got back in Australia may no longer be suitable for their needs.
Yeah.
So it becomes, in the past, they had to sell that house buy a new house, move back to Australia, move into it. Whereas now, under the proposals, they would have to move back into that house,
Yeah.
re-establish themselves, shoehorn the whole family into this tiny little, shoebox,
Yeah.
and then sell it,
Yeah.
and then buy a house that's going to suit their needs.
Yeah. Yeah. Exactly.
So, those out there were saying this is a storm in the teacup. For some, it is. Yeah. I mean, if you're going overseas for 2 years, big whoop.
Yeah.
But if you've been overseas for a lengthy period of time, and you're sitting on a sizable capital gains tax liability, and you're worried about the property market going down, and all these other bits and pieces that come in,
Yeah.
then it is a big deal.
Yeah, exactly. I mean, we've seen the issues at the moment with those markets down south, Sydney, Melbourne, people trying to sell.
Yeah.
Trying to sell at 2017 prices when now we're probably back.
2019, yeah, that's right. Yeah.
Well, we're 2019 prices, I'm going to say 2015, but 2019 prices now, which, the market has gone backwards and people aren't happy accepting, the sale of their properties at these reduced prices because they've seen what other prices have done. So people are biting the bullet and saying, oh, do I wait? What do I do? Yeah. So.
Yeah. And I think that's, you don't really make good financial decisions when you're pressured.
No.
Yeah, when your back's against the wall, you don't have the benefit of being able to see the moving parts and understand the implications and think through the process. You just think, I've got to act. So there are some out there who just acted.
Yeah.
But the benefit for those people is if this law did come in, then they're okay.
Yeah. Well,
if it didn't come in, they can always buy again.
Yeah.
In actual fact, they probably sold at a higher price.
Yeah.
Last year, if they sold last year, they could buy back that same house back this year and probably save themselves 10-15%.
Yeah, but that's right. The way the market's gone, it has gone back that much.
Yeah. So to me, I mean, I think sometimes you've got to weigh up, the downside liability, upside potential, and say, well, certainly if property prices are at record lows and no one was sitting on capital gains tax, then this will be a storm in a teacup.
Yeah, that's right.
But because property prices are so high, then, it is a big issue.
And I suppose, on the outlook of property, where do we think it's heading, property market? Do we think it's still heading down for another 18, 24 months?
I think longer. Personally, to me, there's 3 stages to this pullback.
Yep.
So the first stage is restraint of capital.
Yep.
E.g. banks stop lending.
Yep.
So the heat comes out of the market straight away. Then you get that, there's actually a new, there's, the FOMO, there's now FONGO.
FONGO.
Yeah, fear of not getting out.
I was talking to a client the other day about this.
Yeah, so, you always get that. Now, that shakes out the short-term speculators, investors.
Yes.
Then you got the combination of excess supply hitting the market, which drives prices down.
Yep.
So that in itself is probably justifying what we're going through now.
Yeah.
Then we've got the next stage, which over the next 1 to 3 years, you've got $500 billion worth of interest-only loans being refinanced to principal and interest loans.
Yep.
The problem you got with that is now that the banks want to know what brand of razor you use and what type of toothpaste you use.
Yep.
All those people who, the reason they got interest-only loan in the first place is because they couldn't afford a P&I loan anyway.
Yeah.
So very unlikely are they going to be able to refinance the interest-only loan by the due date. They're going to have to sell.
Yeah.
So you're going to see a purge in the mum and dad investors who should only have ever had 1 or 2 properties, who suddenly own 4 or 5, who couldn't afford 4 or 5. The only reason they could afford it was because interest only at record low interest rates.
Yep.
So you got to see a purge of that side of it. And then the last one, and this is one that's going to affect everyone, and I think it could be a really bad one, is interest rates.
Yep.
People forget the official cash rate right now is at 1.5%.
Yep.
It has never been this low since Captain Cook first set foot in Australia.
Yep.
If we get interest rates rising from 1.5% to 3%,
Yes.
it doesn't mean your repayments go up 1.5%.
No.
And this is what people don't realise. There's going to be a rapid escalation in repayment requirements in a time when the cost of living in Australia is very high, and people are they're struggling as it is.
Yeah.
Right now they're struggling to make ends meet.
Yeah.
Let alone when their mortgage rates double and triple.
Yeah.
Then you get to see the real purge. So honestly, I think this could be it'll come down, it'll flatten out a bit.
Taper off a bit.
All the real estate agents will go, okay, great, time to buy.
Yeah.
But then there's the next bit and then the next bit. So I think there's actually 2 to 3 stages from this
A few more
pullback.
cycles, but cycles going down.
And it depends on obviously when the RBA lifts rates. That's a big one.
Yeah.
there's a great, and I'll put this in the show notes as well too. There's a great chart chart pack that the Australian Bureau of Statistics puts out every month called the ABS chart pack, and it's great because it's unemotional, it's data, it's binary, it's ones and zeros.
Yeah.
There's no agenda.
Doesn't lie.
It doesn't lie. They're not trying to sell property or like these sort of things. So you can look at this data and make incredibly informed decisions without emotion.
Yep.
The one that concerns me the most is, and I said I'll put this in the link in the show notes below. When you look at mortgage defaults, or what they call bad performing assets by the banks, mortgage defaults are on the rise.
Yeah.
In a time when interest rates are at record lows.
Yeah, I see where you're heading.
So when interest rates start to rise, we're going to see, and not only that, but when you look at the other chart that grabs my attention as well too, is the ratio of disposable income to debt. Believe it or not, in the peak of the GFC, it was about 110. It's 125 now.
Yeah, okay.
So we're actually, when you look at your disposable income versus how much debt you've got, we're at record levels now. We've smashed the GFC.
Yeah.
And I think this is why the RBA are running scared.
Yeah.
Because they know if they tap the brakes and they start to raise rates, I tell you what, there's going to be, I reckon, 1 in 3 households in Australia would be in default.
Yeah, well, it's typically an inverse relationship.
So it is.
One, and then obviously you're going to see everything else, topple over.
That's right. So
it's going to have that negative impact.
Bingo. So look, I think, I'm pretty nervous about the property market right now.
Yeah.
And if I look at the commentary by people who don't have a vested interest, they're all saying the same.
Yep.
The ones that aren't saying the same are the ones that are trying to sell things.
Yeah, the ones that are already in the market going, what do we do?
Exactly. I mean, there's the newspapers that drive a lot of ad revenue from real estate agents.
Yeah.
They're putting in the good stories.
Yeah.
There's the newspapers that are more on the fence that aren't swayed by that sort of thing. They're the ones running the real stories.
Yeah.
There's the data companies that sell their data to real estate agents. They're saying, hey, it's all good.
Yeah.
And then there's the data companies that don't sell it. Yeah. They're going, no, this is not good at all.
Yeah.
So always do your homework in terms of where you're reading things from. Look at the source. So
yeah, exactly. Make sure it's not someone's not receiving a benefit from it by
Bingo.
putting it out there.
Yeah, that's right.
Yeah, exactly right.
That's right.
Okay, well, I mean, fair bit on the MRE just then.
Yep.
Obviously, we'll hopefully know more next month. So
2nd of April, 7:30 p.m. Be there or be square.
That's right.
Or then if you can't watch it live, then certainly tune in to us on the webinar the following day at 10:30 and 9:30.
Yeah, that's right. 2 opportunities to tune in, so don't miss out. Otherwise, the recording will be sent if you've opted in to receive it.
Yep, definitely.
Okay, so we've discussed a fair bit then on the MRE.
Yes.
And obviously we've touched base on when the webinars are coming up, so obviously don't miss out. Now, I just want to lead you into one of the biggest financial risks that expats face. It's something which I honestly think not a lot of expats actually consider, yet it is one of their largest risks when they are living and working overseas. What is that risk?
Currency risk.
That's right.
And it's something that, I think they're aware of subconsciously, because when they're trying to move money around, it's up and down, it's up and down.
Yeah.
But they never think of the implications in the long term.
No.
Probably the most commonly asked questions I get is, where should I accumulate wealth as an expat?
Yes.
And the answer is pretty simple: where you intend to return to or retire to.
Yeah.
Because if you do that and you are accumulating wealth in that local currency, then when it comes time to return, your money's here waiting for you.
Yeah.
You're not going, I hope the currency's up, I hope the currency's down.
At the end of the term,
Bingo.
finishing in that foreign country.
Yeah. And we had this with clients in the UK through Brexit. I had 2 families who were about to return back to Australia. All of their wealth was sitting in sterling.
Yeah.
And obviously the Brexit surprised everyone.
Yeah.
The pound fell 15%. And they had to delay the repatriation by 2 years.
Yeah. Yeah.
Which really stuffed them up because they had schooling issues, all these sort of things they're done. And, I said to them, either take a financial haircut and move for personal reasons.
Yeah.
Or if you want X dollar amount, you're going to have to wait there.
Yeah.
Until they comes back. I mean, I remember catching up with an old schoolmate of mine in Singapore a number of years ago, and he's been there for a long time. Mm-hmm. And every 8 years he has his chat with his wife.
Yeah.
Because around the 7-8 year mark, the Sing dollar breaches parity with the Australian dollar. Mm-hmm. So it's actually a good time for them to move back to Australia because all their assets are in Singapore.
Yeah.
And as he said to her, and Paul, if you're listening on this, g'day, he said, okay, if we're going to do it, now's the time.
Yeah.
Because we're all holding our properties in Singapore dollars. All these things are in Singapore dollars.
Mm-hmm.
If we're going to move back and get as much purchasing power as we can, we do it now.
Now's the chance.
Otherwise, we wait another 7 years.
Yeah.
And they decided to wait another 7 years.
Yep.
So, but that just goes to show the ramifications of holding all your wealth in a foreign currency is.
Yep.
7 years is a long time.
Oh, absolutely.
And, Murphy's Law always says that when it comes time to move, something will happen.
Yeah.
We saw a reverse situation with the Swiss franc and the euro a couple of years ago. When they depegged the Swiss franc against the euro, the Swiss franc jumped 40%. In 45 seconds. Ended up closing the day up about 18%. But imagine that was the reverse.
Yeah.
And you're just about to get on a plane, and suddenly your wealth is 40% less.
Yeah.
So you've got that issue.
What about the issue of tax?
Yep.
Moving money between countries. How does that operate?
That's an interesting one because that's actually our most popular, apart from our homepage, our most popular blog post on our whole website.
Yep.
Do I pay tax on repatriating money back to Australia?
Yeah.
And the answer is relatively simply no.
Yeah.
Depending on the source of the funds, how you've paid tax, whether it's applicable or not, residency is a big one. So, there's a lot of fear-mongering out there by primarily offshore providers that say, do not send your money back to Australia, the ATO will tax you.
Yeah. And there's always that magic number, the $10,000.
Yeah, exactly. Yeah, and by all means, do not send back $9,999.99. I mean,
it's more suspicious than anything.
Of course it is. I mean, the computers from Austrac look at every transfer. And it's got to flag that more so than if you did $10,001.
Yeah.
Only because you're seen to be trying to get under what to me is not really a fair threshold.
A well-known threshold.
It is, but it doesn't really mean anything.
No.
You can get pinged for $3,000 like you can get pinged for $300,000.
Yeah.
So, when it comes to moving money back to Australia, if you're deemed to be a resident or have resident tax status ties to Australia and money's coming in, then the ATO may deem that as you're working overseas trying to avoid paying tax and you're bringing money back to Australia.
Yep.
If you're a resident in Hong Kong, Dubai, London, and you're earning money there and you're paying tax there, and you're sending money back to Australia to either pay a mortgage, kids' school fees, start an investment account, top up super, there's nothing wrong with that.
Yeah, so, I mean, basically, you want to send money back, but you want to make sure it has a purpose.
Yes, that's right.
So, for an active purpose.
Look, don't send it back and just have it sitting in a bank account.
Yeah.
A, the interest rates are absolutely crap.
Oh, they are.
Why would you bother?
Yeah.
And B, it does raise suspicions that it could be deemed as a salary or, living expenses.
Yeah. Yeah.
As opposed to money coming back, okay, I'm going to go set up an investment account with blue chip shares.
Yeah.
Or I'm going to go and buy a property, or all these sort of things. There's a equally weighted offset to the money.
Yeah.
So if Austrac or the ATO does go, why did you transfer $13,000 back? It's like easy. I'm paying for my kids' school fees.
Yeah. Yeah.
Simple.
Yeah. Straightforward.
So it's the urban myths in expat land are they're always quite humorous.
Yeah.
We always laugh at them, but they are founded based on fear.
Yeah.
And people just do not know how to act. So happy to go on the record. As long as your tax status is solid, you've paid the tax where you should have paid the tax, and you have a reasonable and defined purpose for those funds, transfer away.
Okay, now let's look at a different scenario. Okay, I've left money overseas, but I've returned to Australia.
Yep.
I've left money, what's going strong? US dollar.
Yep.
So I've come back from the US, I've left 50,000 US. I've been a tax resident now for 18 months in Australia, and I've left that money in the US and I bring it back.
Capital gains event.
Exactly.
No different to buying gold at $1 and selling it for $2.
Yep.
Your cash is a financial product.
Yes.
You're seen to be getting a capital gain out of taking that arbitrage opportunity by you've had the opportunity to bring money back to Australia.
Yeah.
The reason you left it overseas, unless, in very rare circumstances, but more often than not, you're trying to game the system.
Yeah.
You're like, well, I'll leave it there and I'll try and get a better exchange rate.
Yeah, yeah.
the ATO views that as a capital gains event.
So, I mean, it's typically the case when you re-enter the country or re-entering Australia, tax residency is formed now that you're back permanently. So, therefore, it's almost like the cost base on the currency. That's when you're starting to accrue some sort of tax with the ATO.
100%, yeah.
And obviously, if it goes the opposite way and you make a currency loss, that's great.
That's great.
It's
Tax losses.
It's a capital loss.
Yeah,
you can
that's
use it
right.
to offset other things. Capital gain, absolutely a taxable event. Yeah. I mean, there's not generally... There's not really much flexibility there regarding time frames because you're holding a financial product technically.
That's right. Yeah.
When you return, so it's very different the way a foreign super fund operates and all those sort of things.
Yeah. And that's the thing. It's treated like cash is like buying a property.
Yeah.
You know, it changes in value.
Yeah.
So as you said, it might be going up or down. But if you've made a gain, you've had the chance to bring it back.
Yeah.
You haven't taken it back, and that's almost your election to say that I am opening myself to a capital gain or loss on a tax point of view from that asset because of me not bringing the money back.
Yeah, and I remember a long time ago I did a consult with someone who they'd come back to Australia, but they said they had left all this money in crypto assets.
Okay.
And I was just like, okay, don't take me down the rabbit hole. But I was like, listen, it's technically a currency.
Yep.
Therefore, there is likely going to be a currency gain if you're leaving it in there. Just because it's in crypto doesn't mean it's not a taxable asset within Australia.
Yep.
We've already seen the ATO come out and provide, I suppose, recommendations on how it's meant to be taxed.
Look, at crypto is easy for the ATO. They say if you buy crypto as a source of currency to pay for a good, then it's not taxable as an asset.
Yeah.
If you buy crypto and sit on that money, that you're investing. So it's capital gains.
And that's what usually everyone's doing. They're holding, the top three or whatever, the Bitcoins and whatnot.
Ethereum and
the Litecoin and everything. They're holding it because they know it's likely to go up. Yeah. Obviously, we saw the overnight Bitcoin millionaires. That's obviously all changed now.
Yep.
We look all
that's right. Wrong side of the tracks now, yeah.
Yeah, exactly right. I mean, that's great. You played clear clarity there on overseas currency, transferring it back when you're a resident versus non-resident, how tax can be applicable or not applicable, and obviously sending it back for that active purpose that you ran us through. So that's really good.
I mean, think of this scenario. If you use a dollar cost strategy to repatriate currency over time, some months, as opposed to other months, you got to get good and bad exchange rates. But it should smooth out over time. And I remember doing this as an experiment for a client in the US. And this was when the dollar was about 84. We were on the way back down from parity. So the dollar hit $1.06, $1.07 to the US. And, I was trying to talk him through the process because he didn't want to send money back when the Australian dollar was higher than the US. And I said, take emotion out of it. Just on the first every month, just do it. And he didn't believe me. So I went back and looked at the data for 10 years. And if he followed what I was talking about, instead of getting 84 cents in the dollar, he would have got 74 cents in the dollar. Because people, when the currency hits 71, they go, oh, it's going to go to 69, I'm going to do it then. They never do it, and it goes back up to 85, and they end up transferring at 85. Whereas if you make a disciplined approach to remove emotion, just set something up monthly, quarterly, annually, doesn't matter what it is, but by taking emotion out of it, some months, quarters, years you'll get bad ones, but some you'll get really good ones too. And if we see, mind you, the Feds this week announced that they're going to put rates on hold in the US for probably the rest of this year.
I think they overcooked it, to be honest.
But there is still talk about interest rates falling in Australia. If they do that, the dollar's going to have a 6 in front of it.
With widening interest rate cap.
Exactly.
Yeah, absolutely. And I think a lot of our US clients will be quite happy.
Yeah, well, I mean, US clients, Hong Kong clients, Gulf-based clients, any currency that's pegged to the US dollar, they'll be loving it.
Yeah, exactly right. I mean, we've talked a fair bit on currency, but one thing that I didn't mention was transferring money back.
Yes.
How to go about it.
Do not use the banks.
Yeah.
That's all. Yeah, that's the biggest one. It's. I wish I could be in this caper, and it is a caper.
Yeah.
They'll say to you, we don't charge you any fees at all. And you think, oh, fantastic.
Amazing.
But what they don't tell you is the exchange rate they give you can be 3 to 5% higher or worse than alternatives.
Yeah, using a currency platform.
Exactly. And these days, there is no excuse now. These days, we work with OFX quite closely. And you can almost get your money into Australia in the same time frame using a currency broker as opposed to a bank. Now, people are obviously, they're obviously, not lazy, but time poor. So they're like, I can't be bothered setting up an OFX account.
Yeah.
It's just once.
Yeah.
And then it's great because once it's set up and you go, right, I need to move money back to Australia today, you go onto the OFX account. You go, I want to transfer $10,000 to Australia.
Yep.
They'll say, we'll give you that rate.
Yep.
They'll even give you comparison rates with the banks.
Yeah, they do.
And it's amazing how, like, even on $10,000, we're talking hundreds of dollars you save.
Yeah.
And you hit lock in. They'll give you a local bank account. So if you're in the US, they'll give you a US bank account. You just transfer from your Chase or Wells Fargo or whatever bank you bank with in the US to that bank account.
Yep.
2 days later, it spits out in Australia into your Australian bank account.
Yeah, too easy.
There's no slower than a lot of banks.
Yeah.
And I think there's a lot of misconceived ideas out there in terms of how it works. Now there's a lot of I call it startup players in the FX game. They do worry me.
Yeah.
And the reason being is companies like World First, OFX, the reason why we work with those companies is because they actually transfer the cash.
Yeah.
Which is a big difference to what's the one that a lot of people use it for the small balances? TransferWise, and there's a new one now too that's actually in a bit of financial issues right now. They don't actually transfer the money.
No.
What they do is they pool everyone's money together,
Yeah.
and they say, right here, Brett and James are transferring money back from the US to Australia, and Frank and Sarah in Australia are putting money into the US.
Yeah.
The money doesn't cross paths. They just net things off,
Yeah.
and then everyone gets their money.
Yeah.
When it comes to money, I like my money to go where I want it to go.
Yeah.
I don't want it pulled within someone else's and then goes off this direction over here and all that sort of stuff. And, there's a lot of homework you need to do, obviously when picking a foreign exchange broker. The big ones that I always say are make sure they have an Australian financial services license.
Yes.
So you have recourse against them.
Yes.
Make sure they are a member of a complaints authority, like the Australian Financial Consumer Complaints Authority, AFCA.
Yep.
So you can complain to someone. By working with those providers, you have recourse if something goes wrong.
Yeah, they're regulated.
Bingo.
They operate in a highly regulated environment.
Exactly.
So there's almost a bit of self-assurance that things are going to go smoothly. I mean, you've just explained how OFX and how smooth the process can be. I've personally used OFX when I've been over in the UK.
Yep.
And it was literally 2 business days.
Yeah,
and,
that's right.
I got text messages, I got emails, constant updates.
Yeah.
I've even had an account manager call me to help me walk through the process.
Yeah.
So it's setting up the account once, and then whenever you need to transfer money, it literally takes you maybe 1 to 2 minutes, if that.
Yeah, that's right. And I think people just love the laziness of on internet banking. They're on there anyway. Yeah. I'll transfer some money now.
Yeah.
The bank's relying on your laziness.
Yeah.
So don't get caught.
Yeah, exactly right. Okay, so we've talked a fair bit about currency. So now let's move on to a bit of Q&A.
Yep.
So just as an example, so I've got a UN pension. When I retire in Australia, is a UN pension taxable? So I'm happy to address this one because I have a few UN
You got
clients.
quite a few UN clients, yeah.
And unfortunately, it is taxable in Australia. The ATO doesn't provide any relief. There was a court case that was released in 2015 about the taxation of UN pensions. So unfortunately, it is. But one thing that you can do is you can apply for a UPP, so that undeducted purchase price deduction.
Yep.
It might give you a 3 to 6% deduction of your annual income that you receive from that UN pension. To try and reduce it a little bit. That way you're not paying as much tax.
Not much though.
Yeah, it's not much at all, but it's better than kicking the teeth.
Yep.
So unfortunately, yes, it is taxable. I've only come across one sort of organisation in the world that is very lucky to not have their pensions taxable.
Yep.
And that's World Bank employees.
Wow. Okay.
I know. Shocked. I was shocked actually.
Let's go join the World Bank.
I know. So there was a court case that was released. Case law said that World Bank's pensions are not. They're exempt from tax in Australia.
Yep.
And even if it's from the US actually, the IRS doesn't even tax you on it.
Wow, okay.
And when I read that, I was shocked. If the IRS does try and tax you, you can actually apply for a tax supplement from the World Bank, and they'll pay the tax on your behalf. So each jurisdiction is obviously different, but the way it's treated in Australia at the moment is completely tax exempt for World Bank employees. But in terms of UN pensions, no.
I've got to say though, the UN pension is a pretty good one though. If you meet those milestone marks, I think I'd go live in a tent in Africa, work for a while there to get some of those pensions,
Oh my! I mean, well, it's guaranteed for the rest of your life.
Yeah.
So you can either cash out, and the cash out value is usually quite good.
Yep.
Or you can have a guaranteed annual payment made to you. You can even peg it to US dollar or your local currency. And yeah, again, depending on how many years you work for them depends.
Yeah.
But it can be comfortably over 50,000 Australian each year.
Yep.
You've obviously got to wear the tax out of that, but it's a small price to pay for a guaranteed pension for the rest of your life.
Well, it's an annuity, isn't it?
Yeah, it is.
Yeah.
Yeah. And then there's even a benefit of when you pass away, your beneficiary can receive that for another 10 years.
Wow, okay, I didn't know that.
Yeah.
Okay, yeah,
So
that's good.
They take care of you.
Yeah.
The UN definitely takes care of you.
Yeah.
So we're not promoting go and work for the UN. But,
No, that's right, man.
obviously
I will.
the
See you later.
retirement benefits are there if you're
Yeah.
happy working from 10 plus years.
Yeah.
So that's on the UN pension side. So another question, Brett, throw it out to you. I have an investment property in Vietnam which I've recently purchased. I'm living in actually Italy. I'm a non-resident of Australia. I only recently purchased the property. Does the ATO need to know about this investment property?
No.
And why is that?
Because you're a tax resident of Italy,
Yes.
and that's where it comes down to. So, like we've always said in episodes 1, 2, 3, and now 4,
Yep.
domicile, domicile, domicile.
That's right.
So, obviously, you'll have to deal with that with the Italian tax authorities.
Yeah. Yep.
But as far as the ATO is concerned, it's only when you step back in their sandpit, so to speak,
Yep.
and you're back in Australia as a permanent resident,
Yep.
and established residence, do your worldwide assets become assessable.
Yeah, okay. So, I mean, you technically, you don't need to alert to the ATO about it until you return
That's right,
as
yeah.
an Australian tax resident.
And that'll just be something very simple as when you do your first tax return back in Australia, you just say, hey guys, I got this, I'm getting this rental income, or if it's a capital event because you sold it,
Yep.
you've got to declare that as well too.
Yep, easy. Okay, so pretty straightforward there. And then just the last one regarding an expat living in Denmark. So it looks like they might have read an old article that we wrote, but
Yep.
I'm an expat living in Denmark. I'm just wondering if there's any particular investments I need to be aware of. I remember reading something on your blog a long time ago.
Yeah, now this is an interesting one because I haven't actually found any other countries that do this. And there probably are,
Yeah.
but Denmark's probably got the worst rule. I know they are looking at changing it, but essentially what it means is if you own an Australian or any international ETF as a resident of Denmark,
Yep.
then you'll get taxed on what they call a mark-to-market basis.
Yeah, okay.
So if you bought an exchange-traded fund that matches the ASX 200, the S&P 500, doesn't matter
Yep.
what it is, as long as it's not listed in Denmark,
Yep.
you bought it for $1,
Yep.
and it went great guns, and by the end, on the 1st of January, by the end of the year, it was worth $2,
Yep.
but you didn't sell it.
Yeah.
The Danish tax authorities will actually tax you on that capital gain, even though you haven't realised it.
Oh, wow, okay.
So,
Taxation of unrealised gains.
yeah, that's right. So it's called a mark-to-market. They go, rightio, what's the value on the 31st of December? Ping.
Yeah. I know we're not obviously Denmark taxation specialists, but I wonder what happens if you make a capital loss, whether that can be used to offset other capital gains or unrealised gains technically.
Yeah.
And whether you probably wouldn't get to carry them forward because it's year to year, mark to mark.
That's right, exactly.
Yeah. Okay.
Yeah. So you've hit the nail. I was about to say that you've hit the nail on the head. It's from 1 Jan to 31 December.
Yeah.
What happens in that period?
That's what gets taxed.
It gets taxed. I mean, we're sort of fortunate where our clients haven't had losses; they've actually had gains, so we've had to pay a bit of tax. But it's something that just goes to show the nuances of different countries.
Yep.
And Australian expats do move around quite a bit.
Yep.
So their portfolio that they held in Australia may not suit them, in Denmark.
Yeah.
If you had an ETF portfolio in Australia, moved to Hong Kong, once again, deemed disposal. Don't forget one, guys, from last week, deemed disposal.
Yep.
And then, maintain that portfolio. Great guns.
Yeah.
If you then move from Hong Kong to, say, the United States or Denmark, it's the worst thing you can hold.
It is. You're right. I'm glad you dropped the US there
Yeah,
as well.
because with ETFs, they're PFICs.
Yeah, that's right.
So, then that's where we always talk to clients and certainly try and educate expats. Just because you're moving from country to country doesn't mean it's the same system.
Yeah, that's right.
Certainly languages are different and all those things are different, but your personal circumstances can change quite a fair bit or depending on what country you're moving to or from.
And how taxation arises. I know in Switzerland they've got that annual wealth tax. I think
Yes, yeah.
5 to 1.5% on your total wealth, which seems ridiculous. I mean, it's a small percentage, but if you've got quite a large portfolio, you're paying a fair bit in tax just on the balance of it, not actually on the growth, just the balance.
Yeah, that's right. Exactly. It's worth X amount. There you go. Well, there's a tax bill.
Yeah, exactly right. Okay, so taxation does arise every year, mark-to-market election, capital gain, or unrealised capital gains, ETFs. I mean, I'd imagine ETF rule probably manage fund rule as well.
Yes.
Yep.
Yeah.
So, or, I reckon it would probably say in their legislation, foreign mutual funds.
That it's actually ETF. They're specifically referred to ETF, but then when you read the legislation, it does extend to managed funds as well too.
Yeah. Okay.
So, but it's actually who knows the local ETF startup business is probably lobbied.
Yeah.
Copenhagen to try and to say, guys, let's get everyone out. Let's focus on
let's get everyone investing in us.
Exactly.
Not overseas.
Exactly. But what it's actually meant has no one's invested in any of those things. So instead of investing in an ETF, they bought BHP, Telstra, and Wesfarmers.
Yeah. Okay.
So it still doesn't fix the same.
No. So people just choosing to invest in your blue chips.
Well, look, there's a reason why they're investing in Australia, because they want to invest in Australia.
Yeah.
If they want to invest in Denmark, they would have invested in Denmark anyway.
Yeah, exactly. And I mean, when people are doing that, they know the companies they're buying. That's why they're sending money back home.
Bingo.
They understand their businesses. They understand the market itself.
Yep.
Whereas they don't know these ETFs or managed funds that they're buying in the local jurisdiction. That could be anything.
That's right.
Yeah.
Yep.
Yeah, exactly right. Well, Brett, that's all I have to run through today. That's the Q&As.
Fantastic. Well, hopefully, guys, you got a bit of value out of that. And, certainly we appreciate everyone's feedback. We're watching the numbers. They're going up. So thank you very much. But once again, we sincerely appreciate it if you're watching on YouTube. Subscribe. Give us a comment below. Hit the bell so you know when the new episode's coming out. And for those on the podcast, look, it'd mean the world to us if you subscribe and give us a rating.
Yep.
And most importantly, give us feedback.
Yeah, give us
regardless what the feedback says. I mean, we obviously like it to be good, but we're sitting here speaking, thinking we know what you guys need to hear.
Exactly.
But if we don't hear back from you guys, then we'll just keep doing this.
Yeah, exactly right.
So certainly, and if just to say a thumbs up.
Yeah.
That'd make our day.
Well, it's going to let us know that we're talking about the right things, we're addressing the right topics.
Bingo.
I mean, you know that we're talking mainly financial, but there might be something outside of the financial world that we're not touching base on that you want us to touch base on.
Yeah.
I mean, Brett's got a huge background of being an expat, so he is always happy.
Yep.
Shedding his 2 cents.
Yep. 5 cents sometimes.
5 cents. Maybe.
Yeah, $1.80 after tax.
Yeah. That's right. But all right. Well, okay. Thanks for your time today, Brett. That's been great.
Thanks, James, and look forward to talking to you guys on episode 5 of Expat Chat.
Speak soon.
Take care.